IPOs in 2024 so far have raised now more than double since last year's listings. And another tech company going public tomorrow, joining us right now on the IPO window, and so much more that's going on in tech and everything else. Mitchell Green is here. He's the founding partner at Lead Edge Capital, which is now invested in companies like Uber, Spotify, and Alibaba. The year's almost over, my friend.
Almost over.
It's almost over, but it's almost vacation time.
They're going to get one more in.
They're going to get one more in, but the question is, what do you think 2025 really portends here?
It's going to be better than 23, better than 24. It's not going to be a blockbuster year.
It's not.
I don't think it's going to be a blockbuster year. I think the issue you have, and if you actually look at the data, we had looked at it at our annual meeting like a month ago, and I think there's been about 10 tech IPOs over the last 12, 18 months. And 9 out of 10 of them were above the IPO price at a pretty good amount. I haven't looked at Reddit in the last couple of weeks, but that thing had like Sword and ARM and a bunch of these other things. The biggest issue you have is the best companies raised so much money in 20 and 21. They effectively completed IPOs already.
As private businesses.
As private businesses, correct.
Yes. And therefore, you're going to get into the same kind of situation that Stripe is in today?
Correct. I mean, companies such as Grafana Labs, who just did a big secondary that was announced, Stripe. If you think about it, but between 2005 and 2019, when a tech company went public, it would raise $100 to $500 million. Okay, forget Alibaba and Facebook and some of the giant ones. Well, now fast forward to 20 and 21. How much money did companies raise? Like $100 to $500 million. You have companies that have $300 million on the balance sheet, like the best companies, which is probably 10 to 15 Stripes. If you ask the bankers at Goldman Sachs or Morgan Stanley, you'll get there's 10 to 15 companies like a Stripe or a Grafana or things like that. Now there are hundreds of other unicorns that raised that are 100 to 250 million of revenue.
Right.
The issue is they're not growing that fast, and they're all negative 10 to plus 10% operating margins. And if you look at the way public companies are trading right now on like rule of 40, which is take the revenue growth plus the EBITDA margins. So if you grow 50 and have a negative 10 EBITDA margin, you're rule of 40. But what you
explain that again. The rule of 40 is?
So rule of 40 is a metric that a lot of investors use to just describe like what is a good business. And a good business, people like to say, is rule of 40. And what that is revenue growth rate in the current year plus your EBITDA margin. So if you are a rule of 60 business, if you have 40% growth and 20% EBITDA margins. You are a rule of 0 business if you have 30% growth rates and negative 30% EBITDA margins. What you have a lot right now, and a bunch of these like unicorn companies that raised, look, they all missed their financials they originally thought they were going to hit. And so you have a bunch of businesses growing 20, 25% a year that have negative 10 to positive 10% operating margins. And so you got a bunch of businesses.
Rule of 0.
Rule of 0 to rule of 10.
Right.
Those businesses, if you look at the way they trade on the public markets and just look at how segment all the software companies by rule of, start at like rule of 90 and like the Datadog, Snowflakes of the world, and take them down to rule of 0, it is directly correlated with very high correlation. And a rule of 10, rule of 20 business trades on average 2 times revenues or something.
So do those become zombies? Do they become acquisition targets? Do you
zombies for a while? At some point, they will become acquisition targets. The challenge for them is, not challenge, is they have so much cash.
Right.
They themselves have hundreds of millions of dollars off it on the balance sheet, and venture capitalists and private equity investors love to just waste their time and sit on boards forever. Why take the mark and sell it at half the value you have it marked at, when you can just sit on it and try to convince your investors for a decade that it's worth what it is and try to grow into the valuation. There's all these people want it. It's hopes and dreams. It's like, we're going to make this one change and then it's going to grow again and we're going to take it public. Yeah, the amount of companies that re-accelerate after they get to 10 to 20% revenue growth is so rare. And then I think the other issue with the IPO market is you get the venture-funded companies, and then you have the big buyouts.
Right.
The companies that Hellman Friedman or Blackstone and Ares and Apollo own. They all have lots of debt on them. They don't grow that fast. And third, they own the whole business. So when you take them public, you get it. Like we were an investor. We do some stuff on the public side, and we owned a business. It's publicly disclosed in structure that Thoma Bravo had taken public. Mm-hmm. It went public. Post deal, they owned like 90% of the company or something to that effect. If you're Fidelity, Wellington, T. Rowe, please explain why you want to buy the position down from 90 to 80 to 75. You have like a wall of selling in front of you. And so the challenge becomes just getting these big institutions interested in wanting to buy the positions and like massively concentrate. I think it's a big issue.
More broadly, before we go, what is your sense? Just the market has moved. Obviously, it's been a huge move this last year.
God bless Donald Trump.
Right? Yeah. And my question is, if we have this conversation again same time next year, where do you think things stand? Do you have any?
We're not experts in the market. You have like Steve Cohen or Paul Tudor Jones come in and things like that. The economy is pretty darn good. Our companies are hitting numbers. If I talk to colleagues at private equity funds and venture funds, things are doing well. There's still, I don't know what the concentration. You've had, I think, more of a rally in the last 4 or 5, 6 weeks in small cap companies, so that's started to adjust. But look, I think Warren Buffett has like this like ratio he uses of like market cap to GDP or something, and I think it's pretty high. So look, what I do know is that markets don't move. Markets move in the ways that cause the most amount of pain to the greatest number of people. People appear to be pretty bullish right now if you look at like leverage ratios and on hedge funds and things like that. And you're probably one geopolitical event away from something big happening, but who knows? I have no idea.
One geopolitical event away.